This is the Net Group Investments podcast where we explore a variety of views and insights that investors care about. Hello, I'm Demisha Greater from Net Group Investments Multi-Management. This installment of your market and economic wrap is titled SARB's Monetary Moment, Cut or Hold. This week, the focus will shift from fiscal to monetary policy as the SARB's Monetary Policy Committee meets on Wednesday and Thursday. Predicting the outcome may prove challenging, with valid arguments for either another rate cut or a pause. Domestic inflation and growth trends continue to support further monetary easing. Although headline inflation rose slightly from a low base in January, it remains well below the SARB's 4.5% target. However, the MPC highlighted potential upside risks to the inflation outlook in January. Let's recap the committee's two main concerns. Number one, high administrative price inflation, particularly the possibility of significant increases in electricity tariffs. And secondly, the risk that the Trump administration's trade policies could spark a global trade war, leading to high inflation and interest rates worldwide, unsettling investors and increasing risk aversion in financial markets. In this scenario, the rand would likely face substantial pressure. According to the SARB's model, the rand could depreciate to nearly 21 rand to the US dollar, pushing domestic inflation up to 5% and raising the policy rate to 50 basis points above the SARB's baseline. While both risks have materialized, they have not unfolded exactly as the committee anticipated. NERSA has approved a significant 12.74% increase for Eskom in 2025, but reduced the hikes for 2026 and 2027 to 5.36% and 6.19% respectively. These increases are notably lower than the SARB's January forecasts, particularly in the medium term, suggesting that electricity tariff hikes may be less harmful than initially feared. Regarding the second point, President Trump's tumultuous trade war began with a series of announcements. The US administration implemented some of its most severe threats while postponing others. The decision on reciprocal tariffs is expected in early April. So far, China, Canada, and the European Union have all retaliated against the US. Despite global markets largely dismissing Trump's tariff threats, the wave of executive orders unsettled and confused investors, intensifying geopolitical tensions. The VIX, a measure of market fear, surged to levels last seen during the pandemic. Additionally, recession fears have grown as Wall Street assesses the impact of Trump's rapidly changing tariff policies, retaliatory measures by major trading partners, and signs of weakening consumer sentiment on economic growth and policies. Key US indices rebounded impressively on Friday, with the Dow Jones Industrial Average nearing correction territory, which was down 10% from its peak. This suggests that the US economy may be heading for a recession. Well, according to theories by Charles Dow, the indice's founder and first editor of the Wall Street Journal. Dow's theory suggests that the industrial index trend is accurate if confirmed by the transport sector's dynamics. However, since peaking in late November last year, the Dow Jones Transport Index has lost nearly 20% and accelerating its decline 3 weeks ago. This rapid decline has led to the formation of what is known as the death cross, which is a bearish market signal where the 50-day moving average falls below the 200-day moving average. Big tech shares, which were shaken earlier in the week, saw a sharp recovery on Friday. Nvidia shares rose by more than 5%, Tesla jumped 4%, and Meta platforms gained close to 3%. Amazon and Apple also saw increases. Now, despite Friday's gains, it was still a tough week for Wall Street, with Dow experiencing its largest one-week drop since 2023. The Nasdaq Composite remains in correction territory, down nearly 12% from its record through Friday's close. The accumulated oversold conditions in equities over the past 3 weeks suggests a high chance of a rebound. However, the duration of this rebound will depend on monetary policy and incoming data. This week, attention turns to the US Fed's two-day policy meeting, which starts today and concludes tomorrow, with officials widely expected to leave rates unchanged. Regarding other equity market movements, European stocks closed the first session of the new trading week on a positive note. Investors will be watching to see if global market volatility continues amid trade uncertainty. Asia-Pacific markets mostly climbed in Monday trade, with investors closely monitoring Chinese equities. On Sunday, the Chinese government announced a special action plan to boost consumption, aimed at reviving consumption by increasing incomes. Other measures include plans to stabilize the stock and real estate markets and raise the country's birth rate. Domestically, the local market was broadly weaker last week, which aligned with the global market trend due to concerns about the fiscal budget. And despite escalating trade tensions between the US and South Africa, this following the US expelling South Africa's ambassador and criticizing the envoy's views on President Trump, the rand traded firmer on Monday. Bilateral relations have deteriorated due to the US aid cuts and disapproval of South Africa's land policy. Nonetheless, local markets managed to finish Monday's trading session in the green. At the closing bell, the JSE All-Share Index was trading at 88,525 points, up nearly 0.7%. We have come to the end of our note. Until next time, do take care. From the Multi-Management team. Need Group Collective Investments is an authorized collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Need Group Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit netgroupinvestments.co.za. Need Group Investments. See money differently.